Look, I don't see that the war cycle is over yet. I think we have another 3, 4, 5 years to go on rebuilding. I think the confrontational issue is accelerating, doesn't matter where you look at. And so what does war really mean? You spend on military, and then secondly, once that's over, you're going to basically spend on rebuild. I think every war cycle has been really good for commodities. Because it's getting harder to get access to it. Transportation is problematic. We see the same today. And the other thing I think, which is going to be really interesting, I think people will have to compete with central banks. As central banks are increasing their gold holdings, even in the Western universe, I think people all of a sudden will start understanding that's good for them too. So once that mentality starts changing, it's not the price which is going to be important. It's the insurance you have in your portfolio which becomes important.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name's Kai Hoffman, I'm the @JR Mining Guy over on X, and of course, your host for this channel, and I'm really looking forward to welcoming a first-time guest here on the program. It's Juerg Kiener. He's the CIO over at Swiss Asia Capital. He's Singapore-based, so we'll get a very different perspective today on what we usually discuss here on the channel. Of course, he runs a gold mining fund, so we're going to talk economy first, set the scene a little bit, and then dive into gold. Where is gold headed? How much steam is left in the tank? But also, how are the mining companies going to perform? How have they performed? We're in the middle of the Q3 earnings season. Newmont is going to start us off this week with their Q3 release on Thursday after market. So really curious what his expectations are. And he mentioned in his recent September article that the precious metals companies, if they were a sector, they would have the highest cash flow margins in the S&P 500 right now. Sadly, it's only Newmont in the S&P 500 right now, so we'll have to discuss how that impacts and how that compares, of course, but lots and lots to talk about. Do us a favor, hit that like and subscribe button is the best and easiest way to support us here at Soar Financially. Now, it is my pleasure to welcome Juerg Kiener. Juerg, it is a great pleasure to have you on the program. Thank you so much for joining me from Singapore.
Good morning, Kai. It's all my pleasure. Thank you.
Yeah, really looking forward to this discussion and to see where your head is at, of course, as well. And as I said, you're based in Singapore, so I'm sure you'll bring a bit of a different perspective to the table than we usually have. A lot of our guests are either European or US based. Let's see where your head is at, Juerg. But let's start with a general question. What is your current interpretation of the global financial markets and the economies worldwide?
I think from a global perspective, the economies are struggling. It doesn't matter where we look like, if it's Asia or if it's Europe or the United States, we're all struggling with this deflationary environment, with some areas doing slightly better than others. So the Asia Pacific, I think, is doing slightly better because of a very high saving rate and less leverage in the system, and to a large extent not equally involved in the geopolitical struggle which we are facing globally. Overall, I think we are really worried about the fixed income market as monetization is going to continue, and we've just seen the monetary aggregate actually turning up again, which is actually creating the next inflationary cycle going into 2025.
Yeah. Let's talk stagflationary environment. Let's start there. Let's maybe define the term just a little bit, what it really means, and where do you see it? I think everybody knows the definition of stagflation, high inflation during a high unemployment period, but we need to set the scene and maybe describe that scenario a little bit. Where are you seeing it, and do you see any changes to that?
I think I see a shift within the global economy. So you see governments taking a bigger share of the activity and funding much more than there is. We start seeing that the weakness in the corporate sector gets made up by government spending, in green energy, replacement of energy structure, replacing of new supply structure, and now newly actually rebuilding their military capability, figuring out that actually the weaponry and systems they have right now on board are actually dated just Second World War period and not actually valid in today's environment anymore.
of the role of government spending. You mentioned it. Stagflation is also stagnant economies, but we're seeing 3% GDP growth in the U.S., for example. I'm not sure what the exact number in China is right now, top of my head, but it has outperformed expectations in the last quarter, apparently, by 1.1% here. But what do you see the role of governments being here, and how influential and how sustainable is that role?
Governments are here to make sure GNP doesn't turn negative after inflation, and that's really a problematic environment. And so what I'm looking at is that in an environment of high leverage, what you need to do is old equity is getting destroyed and you have to replace it with new equity. So the new equity has come now from the Green Party and now from the War Party, where we're building new equity to keep the ability to print money. And that's the government's functionality in that environment.
Yeah, interesting, because usually governments don't create value or GDP growth, or it's not sustainable usually, right? So what you're mentioning, it's like on the green side, I see that being more sustainable, but the war economies are usually, let's call them Christmas tree charts, right? It ramps up, it drops off, extremely cyclical, for lack of a better term. So the question is, like, how sustainable is that? And do you see even a bigger need for stimulus as well?
Look, I don't see that the war cycle is over yet. I think we have another 3, 4, 5 years to go on rebuilding. I think the confrontational issue is accelerating. Doesn't matter where you look at. And so what does war really mean? You spend on military. And then secondly, once that's over, you're going to basically spend on rebuild. So we're going to have a cycle where my inflationary cycle will continue to be driven by that structure for quite some time.
Good point. I wasn't thinking of the rebuilding part, because that is usually quite important as well, infrastructure. So it should be good for commodities, you're saying, as well. Is that something that I hear between the lines from you as well? So rebuilding copper, is that good for the economy?
I think every war cycle has been really good for commodities. Because it's getting harder to get access to it. Transportation is problematic. We see the same today. So transportation links. War in an environment where your global world splitting into different union means ability to actually get what you need from the source you want to have it gets more difficult. And in general, the more difficult it is, the more higher premiums you're going to pay. Whilst corporates in that environment are willing to spend less money on developments, and that means your supply side continues to stay actually quite tight.
You're based in Singapore, so I'm sure your news or your front page news look a little different than our Western front page news here a little bit. What is dominating the headlines right now? And maybe you can highlight a little bit, like, what's different to Western news if you open the Financial Times UK edition, for example, versus the Singapore edition. What is the main difference here?
I think in general, the Western headlines in Western papers are not changing that much. Naturally, we have more Asian content. And that Asian content, to a large extent, is really focused more and more in ASEAN, India, and China. They are actually the big driving forces. Don't forget, we have here a huge population structure of about 3.8 billion people, which is in a very different demographic environment and has different needs. So if you look at India, they're just about requiring a huge amount of energy buildup. And so you read a lot about how that's evolving, how the solar panel structure is getting evolved, how people are getting engaged in that. You're reading much more about what China is doing in the BRICs. It's probably on everybody's platform of talk here. And that's maybe a bit the difference to what we read in Western papers.
Oh, 100%. Yeah, China is a good point, because I want to follow up on that China stimulus package. And I've asked earlier, is the stimulus enough? But I also want to break down a little bit, where is that money flowing? And how do you see affect the spending patterns of the Chinese consumer?
So if you look at Asia, we don't have a welfare system. So if you get unemployed, you're basically struggling. You have to look after yourself. So our saving ratio in Asia is anywhere normally around 40%. Given the fact that now everybody is worried about losing their job, the saving rate is going up. And so the latest numbers we have saving rates out of China is 52% plus. So that amount of money which is actually going into the banking system gives a lot of stability. And if it doesn't stay within the banking system, within Asia, gold is a very attractive investment by decree, because gold has always been money in Asia. It starts when you get born, you get gold with your date of birth into your structure. And I think that accumulation phase is still going rampant.
I've had a guest on the program who mentioned Chinese real estate market is pretty much dead. Everybody used to invest in concrete gold, meaning real estate, of course, but that is shifting because nobody trusts the Chinese real estate as sector anymore. Is that a shift you see as well? Would you underwrite that? Would you sign that and say, yes, that's a fact? It is flowing into other asset classes now?
I think that's very much like that. I think it's just shifting right now into gold because everybody is long real estate anyway, and despite the subsidies and the government trying to stabilize that, they don't really see much upside. Whereas on the gold side, gold introduced in 2000, China introduced for gold in 2011 a gold scheme for institutionals, and they were underwriting the offering at about $1,250. And then last year we started to introduce the 1 gram gold bar for the retail market. It was underwritten as well at around $1,650, $1,700, with the opinion given by the central bank to its people that the annual return would be roughly about 8% plus. And as you can see, that has panned out reasonably well, and that is creating confidence. And so more and more money is actually pouring into that sector.
You have to repeat that because we've never heard that on the channel before. So the Chinese central bank is guaranteeing your gold purchase with an underlying gold price of, say, 1650, 700, and they're guaranteeing an 8% coupon?
It's not a written guarantee, but a verbal guarantee. And that's actually already good enough. And like that, China is actually rebuilding its gold hoard within the country without having to spend its own money.
No. Interesting. Never heard that before. Okay, fantastic, because that explains a lot, of course, and shows that growing momentum in the gold price as well. I want to come back to gold in a minute here, Juerg, but just as a maybe added data points, I quickly looked up the household savings rate in the U.S. and in Europe, in the European Union, and in the European Union it's 13%, just in comparison to the 53% you mentioned in China, and in the U.S. it's 4.8%. So that's a big difference. I just want to put the numbers into a bit of context here so people understand, okay, 53% is a big, big number, right? But also maybe let's look at that. It also means that 53% of that money is not flowing back into the economy, even with added stimulus, right? How is that adding maybe inflation or deflationary pressures to the economy?
I think if you look at China, having had this big boom and bust cycle and now being worried about sanctions, it's not a surprise that people don't spend too much on the economy, so on consumption goods. They don't spend too much more on housing. So we're just piling money up until we feel more confident. And so I think that's everywhere the same. It's always hard to believe that the future looks better. We start to see money flowing more into India. We start seeing money flowing into ASEAN. We still see money flowing, but not in high numbers. So I think there's going to be a question of time until that accelerates. And for that, I think we need a bit more stability and more earnings visibility.
What about the emerging markets in general? How do you rate and rank them? It's always a buzzword. People say emerging markets. Oh, massive growth in the emerging markets. Where do you stand on those markets, and what's their outlook?
Look, I think GNP growth will continue to be good because our population structure is so much lower. But don't forget, when you do CapEx, because you have growth and you have projects to build, you normally don't create return on equity because it goes through a capex cycle. So that's probably the dilemma we have in many young countries where the money is earned is getting spent on future growth. And that's why your PE expansion hasn't really materialized. But if you look in many countries, the banks have done really reasonably well because the volume in there is just fantastic. The margins are fantastic. The margins in the banking system in non-Japan Asia is significantly higher than what it is actually in Europe or in the United States.
Yeah, interesting. Like I personally like the emerging markets. There's a lot of opportunities still left to be had, and the valuations you mentioned are still extremely low. And we'll come to that. Back to that when we talk about the mining companies, because you have roughly 30% of your portfolio allocated in the Asia Pacific. So we'll talk about. We'll come back to that discussion. But in the meantime, let's talk about maybe the perception of the US Fed in Asia. I think that's an interesting topic because here in the West, meaning in Germany or where I sit, and of course in the US, the Fed is the be all and end all. Like no discussion goes without talking about the Fed. How important is the Fed and the Fed's funds rates to you in Asia, and how much is it being discussed?
Look, I think it's in everybody's papers here in Asia. I think we are very dollar-centric to a large extent, but decoupling more and more. From a trade point of view, we have decoupled a long time ago from the United States. Not really that important anymore in many countries. The inter-regional trade has grown so significantly since 1990 that, the volume from 80% dependent on the US structures and the Western structure has now flipped probably the other way around. So the majority of the business here is not anymore the West, it's regional inter-Asia.
How is the Fed impacting what you're doing at Swiss Asia Capital, Jörg? And how are you looking at it? How are you factoring it into your investment decisions?
So let's look at the Swiss and the Singapore economies are very similar. We are basically nothing else than a dollar proxy. So let's exclude these two countries because like Singapore is maybe not really Asia. So from an Asian point of view, or from an investor point of view, I look at the dollar because it's still driving the whole derivative market. It drives the volatility and it drives fixed income markets globally. So to me, from a macro point of view, we still look that the Fed will continue to have to monetize and that preferably at lower rates. In the short term, we might be holding that into the election period or early next year. And I think by next year, we're going to have massively more inflation. And I think you see that already the longer end of the bond market. And it's going to be really problematic then on the shorter end too. So that's from my point of view. I think everybody in Asia might have a different view. We have so many different countries with different requirements. So it's not for every country equal.
No. You brought up the bond market, and I want to stay on that topic. I threaten you if you bring up the bond market, I'll quote Stanley Druckenmiller, bring Stanley Druckenmiller into the discussion, because I've read over the weekend that 20% of his family office funds are short U.S. bonds right now, and I think that's a really important signal. He is the bond king. Like, I'm curious, what do you make of that, and what should we as like Joe and Jane six-pack investors here take away from that statement?
I think if you believe that economies are not really growing in real terms, then the only way to keep the ship afloat is to print more money. So the absorption of that money will be a bond market which doesn't get any bids anymore. And why do I say that? If Asia Pac or the BRIC countries are increasing their bilateral trade in non-dollar trade, the velocity of dollars is going to shrink, and that's going to mean that the Western central banks will have to do more of the bidding. And that's unfortunately only possible by printing more money. And that's unfortunately going to be really inflationary.
Do you have a timeline in mind when that might happen? Like, I've chatted with Michael Howell here on the channel just late last week, and we talked about the debt wall of worry, because there's a massive debt wall in the U.S. coming where a lot of refinancing needs to happen, and you brought up liquidity to a degree and velocity of the U.S. dollar. So, like, are you worried about that at all? Like, eventually hitting that debt wall?
Look, governments can monetize as much as they want, right? And the interest rates are far too low right now to worry about the monetization. So I remember, I think I was in the Channel Islands in the 1990s, and I think Britain had interest rates going up to 14, 16%. And I think at 12%, we started to load up long-term bonds. We still went to 15, and on the corporate side to 18 before it cracked. So I don't know how long we're going to be until governments are having to throw in the towel, and throwing in the towel means the currency will go. And when your purchasing power of the currency go, the money will have to flow into different assets for protection.
Currency is an interesting one. I was just looking up the US dollar DXY chart, and it's showing remarkable strength. We're back to over 103.5 or 103.6 as we're speaking. Where is that strength all of a sudden coming from? Is it from the US elections? Like, why is the US dollar all of a sudden gaining strength? It looked like it was going to break down and drop below the 100 level here on the DXY.
So imagine you de-dollarize as an economy, and if the BRIC countries de-dollarize, what do they have to do? They have to buy back the US dollar to issue the debt. So in the short term, you're going to get actually dollar strength because of the dollarization. But once you reach a critical level, that purchasing from rollover is going to disappear. So you becoming your own bond king, and I think depending how fast the dollarization is going to go, the faster the strength in the dollar will disappear. The other thing is, if you look at Europe, it's a sign of this desperation, and you see capital flight out of Europe, going particularly United States, a bit to Asia, and that is a real troublesome part. This capital flight keeps as well supporting to a certain extent US dollar.
Interesting. Like, I want to talk about the dollar decoupling that you mentioned just in a bit more detail as well. Like what you're seeing in Asia, maybe as a first-hand example maybe as well. Like the dollar decoupling, de-dollarization obviously is a big trend, and the US dollar share as part of the global transaction keeps dropping outside the Swiss system. I think it's down to mid 50% level roughly right now. So I'm curious, like, where do you see it in Singapore happening?
Look, I think, as I said, Switzerland and Singapore, we are a dollar proxy. So we don't see necessarily the same flows. We are not going to be member of BRICs neither by default. So you have to look outside Asia, and if you look how many Asian countries are applying to become BRIC members, you actually should start thinking, what are they going to do to reshift their treasury and the saving structure for the economy as a central bank. And so all of them will have to go the way China goes, because China is the largest trading partner for everybody here.
Juerg, do we dare speculate about what might come out of the BRICS meeting tomorrow as we're recording? I think this is happening October 22nd. We're recording on the 21st, just because I will be releasing this interview on the 22nd, so there's a speculation involved, and we won't have news out of Kazan. But I'm curious, like, what are your expectations sort of on what you've been touching on? Like, they're looking for a second reserve currency in the world to base their trades on, and BRICS meeting, I think, could be pivotal in that regards. Like, what are your expectations there?
Look, I'm not really expecting that we're going to see a currency coming out of that meeting. What I'm looking for is that the level of bilateral trade arrangements will be increased substantially. And that means all these members will have to have more gold on the balance sheet. And that's why you start seeing they're buying like mad, because they're going to need roughly 40% gold backing to cover the trade. So, and when I say to cover the trade, it's going to be the balance of outstanding trades. So that's probably the main thing which I'm going to see. And the other thing is probably an implementation time frame of these activities, including maybe by when they are looking to finalize the payment token. So I'm not expecting it to be final by the meeting, but I would like to see the pipeline and the development plan, which is actually going to put a lot of structures together.
Yeah, no, it will be really interesting. I think we'll see a lot of commentary coming out of Kazan here in the next few days, and obviously we'll stay on top of it. But let's shift focus a little bit. I threatened our audience that we're going to talk gold, obviously, and read an interesting article. At least it was more of a summary of current events almost in the Financial Times this morning, and the title was "Why the West Should Pay Attention to Gold." And I think that's a really fitting article for what we should discuss as well. Like, in your opinion, why should the West pay attention? Because if we're seemingly not.
I think the first reason is Basel III, which came out actually 22-23, where Basel III decided that you can't really short gold without having collateral in the system. So it basically tells you that all central banks, Western central banks and Eastern central banks, are in the accumulation mode of gold. So what's good for the central bank should be good for the people on the ground. There's a reason people are buying more gold. And I think the gold structure, which even the Western central banks are needing, or actually to be able to still trade with Asia down the road when they become a BRIC member.
So you're actually saying, indirectly saying, that the West doesn't own enough gold to compete with the BRICs and maybe the Eastern countries right now? Is that a trend you're seeing?
Look, if you look at the old-fashioned statements which came out of gold holdings, then Europe looks actually quite well. But Asia has a lot of gold, which are probably not part of the statistics. They might not be in the central bank, but they are in the domain of the people. Gold savings is one of the biggest things we know in Asia. And if you include all these gold holdings and would actually use it as potential ability for supporting the government, like what we've seen when Korea went belly up in 1998. It was the people who were bailing out the Korean National Bank by bringing the gold to the table to recapitalize the balance sheet. So that gold is available in worst case environment, and that gold structure and ownership in Asia Pac is a multiple of what's actually been shown on the balance sheet of the central banks.
It almost feels like in the West we tell everybody not to own physical gold because it seems like if people own physical gold versus, let's say, the US dollar, it's a threat to our society. Right? It's a strong statement here I'm trying to make, but I'm trying to make a point. Like, people are not incentivized to buy gold like they're in Asia, for example. In the US, they're almost dissuaded. And in Germany, I think I read a statement, if you own gold, you're a Nazi. Right? Like, things like that. So, like,
yeah, I
why is the mentality so different? Like, no, I think it was a German cabarettist, like a German wannabe comedian, quite honestly, like who said that on TV. But that's sort of, it really like shows the framework, because if you own gold, you're usually right wing, you're conservative, you're against the government, right? But why is that framework? It's mind blowing that we don't look at it differently here in the West.
So you see, maybe in the West, what you say is you're being shown that you're against the government. In Asia, we think different. We don't trust our governments, so we protect ourselves, and gold is the protection tool we have. And inflation in emerging markets has always been a problem. We've never gone around and told the world, we have zero inflation. So when your interest rates are zero and everybody sees inflation, we know where to protect ourselves in Asia Pacific. Don't forget, we have many crises since the year 2000. We had an Asian crisis, we had multiple crises going around, we had countries blowing up. So I think from that point of view, the safety net is not in government money, it's in gold.
I think some of us Germans understand that, based on the hyperinflation we've seen back in the 1920s, of course. But I think the general public is missing the point. And maybe to drive that point home, we've seen outflows in the European gold ETFs in September, for example, and into a rising gold price. And maybe as a follow-up question, is gold too expensive? And why are we seeing selling?
Look, if I look at the percentage holding people have today, what they have used to have in the 1980s, then the ownership is still low. We are about between 0.3 and 0.5% of investments in the Western universe, according to whatever statistics you read. And I think we're going to go probably to somewhere between 5 and 10% in the next few years. And that's going to drive prices higher, significantly higher. And I'm just wondering where people will get the price or the gold at that price you get today. I don't think it's possible. So the price will have to go up. And the other thing, I think, which is going to be really interesting, I think people will have to compete with central banks. As central banks are increasing their gold holdings, even in the Western universe, I think people all of a sudden will start understanding that's good for them too. So once that mentality starts changing, it's not the price which is going to be important. It's the insurance you have in your portfolio which becomes important. And basically the preservation of your wealth.
Well, we've seen momentum pick up, Juerg, and is it a crowded trade yet? Like, is it overbought? Like, just trying to use some of those technical terms here, but like, is it a crowded trade, or do you see still a lot of room to go? Based on what you're saying, it seems like there's lots of upside left because nobody's really paying attention.
I have many people who keep asking me, if they should buy now after it's been rising, and they missed the boat buying when I told them a long time ago to buy, and they continue to hope for dips. So the more people are hoping for dips, the less likely we're going to get dips. And I don't really see that we have today already a wide exposure to that, particularly not in portfolios. I mean, if I see that people are upgrading in private banks and international banks, the gold holdings, it's still so low that it will not make any difference to the security of the portfolio.
Don't hope for dips might be my YouTube title. I just wrote that down. It makes a lot of sense because we've had a lot of guests on as well, like buy the dips, all right, as well. And we've seen a couple like smaller dips, like gold back to 2,600. It's been testing and taking a breather here, not correcting as hard as I personally would have thought. Like, hard is a strong term, but it corrected less than I expected it to, because it was a big run up to 2680 at some point, and now as we speak, it's 2730, and absolutely unprecedented levels on the technical side, of course. Do you have a price prediction in mind when you look at it? Because I know you for your gold mining fund, for example, you got to have some expectations and ratios, and I'm sure your Excel sheet with some predictions in there is like, what do you put in?
So to be honest, I have no predictions, except it's an upwards prediction. The one thing I know that volatility is still far too low. If you look in the 1980s, we had, $100, $80 swings on a gold price of 800. So that's 10% swings intraday. Our swings intraday from a vola today are a fraction of that. So I think we're going to get a much wilder market, and it's going to be hard for traders actually to pick up real physical supply. And that's why I'm saying you just buy on a regular basis. Don't worry too much. 10% swings up and down is the norm. Once you understand that, you're going to be okay. If you worry about volatility, you will never enter.
Let's discuss why volatility is good for the gold price at this point. Like, maybe help us understand that concept. Does that just mean that there's more availability, that more traders are coming in and more liquidity? Like, what's the rationale behind more volatility in the gold price?
Right now, my volatility is actually historically really low. Mm-hmm. Right? I mean, if you get 4 or 5% vol, it's actually right now cheap. But gold, in a bull market, the volatility goes up. And it goes up because what you're going to have is more people entering the market, and they don't enter just physically, they enter on the end through derivatives. And derivatives, unfortunately, are unlocking quite easily, particularly in an environment where on the end, your moving average is getting far away from where your spot price is. So at the moment, I'm not too much worried about that, but I would expect volatility to increase.
Okay. No, I appreciate that clarification. Just jumping down that rabbit hole with me here for a second. But I mentioned it in my intro. We need to talk about the gold miners. You run a gold mining fund, so I know you'd have a close eye on them, of course. And we're only a few days away from Newmont publishing their Q3 financial results. We've got a bit of a taster from BRIC last week. They announced some production results and gave a bit of guidance in terms of cost. I've done a very, very rough calculation, and my estimate is about $950 margin per ounce. Depends if they hit on the low end. That's almost $1,000. And how does that track, and how have those margins been improving, and what are your expectations, of course, for the Q3 numbers, Juerg?
Look, the Q3 numbers are more or less already in the cake. They were done on gold prices, which were, $200-300 lower than we are today spot. So I don't think it really matters too much what people will report. If they miss guidance, then maybe the stock will fall 5% or 7%. But pretty soon, I think what people will start looking at is what's your margin doing in Q4? Because don't forget, we already have the first months under the belt with margins which are already increasing further. So the best miners will outperform, and the people who are missing, unfortunately, they might struggle a bit. But don't forget, the market is small. As people are entering indexes, the larger miners will move by default, even if they miss. It doesn't really matter that much.
Yeah, I mentioned in a previous interview that we've seen a proof of concept for the miners. They're moving. We've seen up the GDX, for example. I keep referencing is up. I haven't actually checked the last few days, but we were up 35% roughly, sort of in line or just slightly above the gold price, which should be up around 30% right now, year to date even. So they're tracking. We've seen they can move, but they should massively outperform. Why are they being held back? Like, what is still missing?
Look, I think in general, people had since 2011 more disaster year than good years. So there's a lot of pessimism in it. And that's why when you said, the miners have done the same amount in gold itself, it already tells you that doesn't make sense. So in other words, the whole market is telling you that the margin is not sustainable. And so that tells you as well that most people think actually that your gold price is too far from the moving averages. And I think the market has always two ways to go. The moving averages can go up or the price can go down. I think the moving averages will go up because nobody's in the market yet.
Yeah, good point. Like the Q3 average gold price was $2,474, and we're pretty much exactly trading $300 higher already. So I'm really curious what that will look like in Q4. But we're always saying like, oh, next quarter. And to be honest, I'm getting slightly tired of it, because if the Q3 numbers and $1,000 margin in the big miners doesn't convince you that there's an opportunity in the market, what will? And that's an honest question, actually.
It's a very good question. And if you look at the very large miners, let's say you produce 7 million ounces a year, you've got to replace 7 million ounces on your balance sheet to stay put. Right? If you think you're using that much up, so you have to recover that. That means for a lot of the large miners, a lot of people think, how are you going to find another 7 million ounces? So what multiple will they give to a utility? Basically, utility, okay, it's got a higher utility price, but that's about it. So I think the real money is going to be made by people who are able to increase the reserve, the resources, and the production, because you get multiple expansion. And there's multiple expansion right now for mid-tier companies which are in a growth mode. They have multiples which are below the large ones with growth. And I think that's where on the end returns will be made. And that's where maybe, in periods where uncertainty there is, you have to focus on companies which have top good management, a good balance sheet, great growth numbers, which are baked in the cake more or less. With that, your risks are actually falling because you're not missing always estimates. And if you don't miss estimates, you get higher P multiples. And I think, that's actually right now in an environment where not new money is entering the market, the way to make a difference in your performance.
One way of cheating the market a little bit by the big miners is by adapting their reserve price or changing their reserve pricing for the calculated ounces they have on the balance sheet. And I've looked it up recently. I think Newmont is around $1,530, BRIC $1,480. They're all give or take around $1,500 reserve. We're trading $1,200 higher. Do you want them to adjust those reserve calculations and maybe move those prices higher, or are you comfortable with where they're at? And I'll give you my rationale real quick before I let you answer. Because if everybody screams for M&A, like you sort of indicated, they have to replace, otherwise they're just depleting their balance sheet. Obviously, they have to replace ounces, but by adding or by increasing the dollar, the cutoff grade might come down. They might add ounces to the balance sheet, and they don't have that much pressure to buy. So that's sort of the background to the question. Do you see that hindering M&A as well?
Look, the moment you start doing it, your M&A will become more costly. And so my question then is, what's better, finding your ounces yourself at a cheaper cost than what you start putting now into reserve ounces? So if you can add a reserve ounce at half the cost, which is the market, you're a winner. You're not really very smart if you pay the market price of replacement.
Yeah, no, that makes sense. And there's still a lot of cheap ounces to be bought out there. We've seen quite a bit of M&A in the sector already. It's heating up. Anglo Gold buying Sentiment in Egypt. First Majestic buying Gato Silver. Core buying Silvercrest. But those are all producing mines. Not a lot of development assets have changed hands yet. Do you see that changing, that trend?
I see developers or smaller miners which are buying assets which are going into development, which they are able to add value to bring them to the market in a short time frame. Otherwise, large investments into exploration, that's still difficult. I think that's still to come. But a lot of these companies are trading right now at throwaway prices. The question, who's going to be the first ones who start adding some of these companies to the balance sheet? And you see some of the companies which have been doing that in smaller form and shape of money. So it's starting already, but we haven't seen really big ticket items.
I promise we'll get back to the topic of Asia-Pacific allocation in your gold mining fund. You mentioned to me it's over 30% or right around 30%, which is really high because a lot of the other funds are usually more North America or South America-centric, maybe Australia. Tell us a bit about your regional allocation here.
So our largest exposure is in Cambodia, which for a lot of people is a surprise, and they might think it's a huge risk. And for us sitting in ASEAN, my risk, I think, is a bit different because I'm looking at a mine where the court of jurisdiction is Singapore, and most of the Cambodian money sits in Singapore. So therefore, I've been de-risking from that point of view already my investment. The second one, it's owned by an Australian company, so I've got the same mining code. than there. So there are abilities to actually de-risk structures. And I think that's what a lot of people have to think when they are investing in any emerging market. How are they able to reduce risks which are maybe looked at by other people in a different way?
No, interesting. You mentioned before in the record button that the valuations in Asia or in the Asian region are much lower as well in comparison to maybe companies in the US or Canada. Why is that? Like, why are they trading? Is it just risk perception?
No, I think to a large extent, maybe that's true, but there's well a question what the brokers are using for the evaluation criteria. I think in Canada and the States, quite often the 5% discount rate is used for a junior minor, whereas in Asia Pacific, we are closer to 10 or 12%. So that makes already a huge valuation differentiation.
In terms of portfolio allocation, and we don't have to discuss names. I'm not sure what it looks like on your compliance side, but like, how is your portfolio structured in terms of like major companies, like the Newmonts of the world? I see you own some royalty companies as well, but can you break that down for us a little bit?
We're owning very little on the very senior space because we don't see the ability for them to grow. And I think for a lot of people, they can buy them themselves. They don't need added value. So most of our money, or 70, 80%, sits actually in the mid-tier segment, but most of them are producers. So we are looking at this revaluation of these companies going forward, really.
Yeah. No, lots of upside there because there are also potential acquisition targets, but they might have to buy as well. Like any single asset producers in there? I'm curious how you rate those single asset producers.
So when we have a single asset producer, then we actually like if the company has another or two other assets which are in development phase. So they're going to have the ability to become a 2 or 3 asset producer. So if this pipeline and the funding and everything is there, then we have reduced the risk already substantially. I think jurisdiction is a key. If you have a single asset, then where is it? What are the risks within the country? I think for us, country risk becomes really big. Everybody tells me North America has no risk, but we can have 30% in a country. And I keep telling people we used to have energy trusts, I think, in Canada, which was interesting, which were tax exempt. And I think the government at one stage came in April and said, your tax exemption is gone since the 1st of January. So I think you have risks in every country. So when people say there's only risk in emerging markets, I think I disagree. I think we have good and bad emerging markets. And I just can't afford anymore owning 30% in Canada or 30% in America because I've got their risks too. They might be different, but risks is everywhere today.
100%, I do agree, and they're just different risks. It doesn't matter where you are, right? One last thing, like we haven't talked about, is silver, because I see you have an allocation to silver bullion in your fund as well. Let's stay on silvers. Like A, why silver bullion, and B, of course, like what do you see? What's your outlook for silver here?
Look, I think what we are seeing is huge demand-supply problems in the silver space. I think you've seen India pointing 4 different companies to build solar panels. So they're taking each probably about 200 million ounces of silver off the table to go into production, which means it keeps the market really tight, incredibly tight. And the other thing which is interesting, if you look at the Silver Institute, there is no line of demand for military purpose. And if you look at today's military expenditure is going into hypersonic space, military hardware, which is high tech, and all the technology, high tech technology, if it's military or civil usage, uses a lot of silver. And so we're looking at the demand cycle growing in these 2 areas, and that keeps silver from a demand supply side undersupplied. That means higher prices.
And I have to ask the same question, but do you have a price target in mind for silver at all?
Given the fact that we still have a short position of roughly 900 million ounces of silver, I don't know where the price is going to go. I think at one stage, maybe somebody will have to cover some of these short positions. I will not be surprised. So if you get the short, the price could go actually up quite significantly. But without that, I'm just looking at least testing the old highs, which we had in 1980 at $50. It's no big deal, really. It's one of the few metals which is still trading below 1980 numbers.
Absolutely. Juerg, final question, and maybe it puts a nice bow around our whole discussion. Is if I were to come, or if anybody were to come to you and say, Juerg, I have $1 million to invest, how would you allocate that money, regardless of who it is? Like, it's not financial advice, it's just more to put a bow around the conversation to sort of sum up where you see opportunities and risks in the market.
So I think we started in the year 2000. I think we told a lot of our clients they need 10% physical gold or silver in their portfolio. And for a lot of these clients, actually, that position's been growing substantially and is north now of 25. And so we continue to tell people you need a decent amount of physical gold or silver in the portfolio because it's money. It has a foreign exchange code, so it's actually foreign exchange tradable. So you might even have different risks. You can decide if you want to have it physically or through the FX market or in physical position at home. Or you buy it through miners. But physically, to me, it's always the foundation of your house. If it's gold or silver, I think just about accumulating and stacking.
Where do you stand on bonds? Like, if I were to come with $1 million, like, would you add any bonds to my portfolio? Or would you stay away from that?
It's a mean of money confiscation by the government, and it pays you 4 for inflation at 6, or pays you 4 for inflation, whatever the number is. So you don't really get any protection. You don't even get any safety in the environment of this stability. And you're going to get this stability, we're going to get this location, because the world is changing, the way we trade, the way we save, the way we're going to basically do almost everything. I think your corporate structure will change. We're going to have onshoring, which is already problematic. So how are you rebuilding your supply chains and your counterparties? I think it's going to be problematic, which means you have risk actually on money. You have risk on fixed income. And if you look at your fixed income returns, where the government tries to suppress your prices in order to be able to stay afloat, you might not really want to be there.
No, 100% agree. And 60-40 is dead, in my opinion. And in the current, where we're at in the financial system. Absolutely. I do agree. Juerg, phenomenal conversation. Where can we follow you? Where can we find more of your work? And how can we reach out to you?
I've got a website. There's not very much on it. It's called swissasiancapital.com. But people can always contact me. We write every month our monthly feedback on markets and what we see, so people can get on that mailing list if they want to.
No, fantastic, awesome, Juerg. Really appreciate your time. Thank you so much for spending almost an hour here with us on Soar Financially. Thank you so much, and everybody else, thank you so much for tuning in here to Soar Financially. It was great to have a first-time guest back on the program, somebody who is based in Singapore. So we got a bit of a different perspective on how the world is looking at things, in particular gold, obviously. And Juerg really worked out well for us. The difference between Asian thinking and Western European and American thinking towards gold. And I'm curious what your thoughts are on gold as well. How are you allocating to it? Please leave a comment down below. And the best way to support our channel is just by hitting that like and subscribe button. We tremendously appreciate it, and we'll do our very best to come back with lots more great content.